Drawdown is one of those terms that you're going to hear financial advisors use, maybe an economist or two, and you're probably going to read about it on the internet. And it pertains to retirement most in the largest capacity, if you will. A drawdown is nothing more than a percentage of drop of decline in your portfolio once it's reached a market high. So let's say you had $100,000 in your portfolio and it fell to $90,000. You had a 10% drawdown, if you will. Now, there's periods of time where drawdown really doesn't matter. When we talk about the three phases of finance, in accumulation, drawdown doesn't matter. When we talk about preservation, if you're there at the beginning and the middle and the end, the average return is all that matters, and drawdowns in between are really immaterial. But when you get into distribution, that drawdown, that drop down, number one, creates heart palpitations, right? We don't like those. And number two, when you take money out and the market is down, you have a problem because that dollar never gets to grow back up. It's one of the many, many challenges of distribution. Today on Consider This program, we're going to discuss drawdowns and how you need to think about them and how you need to manage around them. Good morning and welcome to Consider This program. I'm your host, Joe Clark.
And I'm Adam Harter.
Happy to have you along. Hey, there are many things that we have to discuss in the financial world when it comes to what we call distribution planning. Distribution planning is when your dollars begin to exit their retirement plans, whether that be your choice, which is what we would prefer, whether that be somebody else's choice, like the IRS, which we never prefer, right? Or when your heirs have to deal with what's left behind. At some point in time, your retirement dollars will exit. And drawdown is one of those terms that you're just going to have to deal with. So, Adam, when somebody walks into our office and has heard the term drawdown, how do you explain that to them?
Well, unfortunately, it's a math term, so you got to go to the math. That's all it is. And unfortunately, and maybe this is unique to the English language, the term applies to multiple things, which is a problem because drawdown to some would mean how much of your portfolio are you drawing down. There's nothing wrong with that, but typically drawdown we want to be kept within this universe of how much are you down, and that's really it is percentage from high. If you want to put it in just three simple English words, percent from high is actually the term that we will click on our charts to turn something into a drawdown chart, which is just nothing more than how much are you down. Now, ideally, you spend a lot of time at zero. If I'm at all-time high, if I'm in a bank account, maybe think of it this way. If I'm at a bank account and I don't take any money out and I'm just accumulating interest, the drawdown will always be zero.
Nominally.
Right. Great point.
Meaning without inflation.
Without inflation, it's always going to be zero. Never down. Inside of an investment account, it's likely to be different. There's at some point in time, you're going to have a percentage from your previous high.
So remember, we preach at the Financial Enhancement Group, you have to understand you're on a financial journey. You know, I think one of the biggest ripoffs in the financial services world is when people try to get you to focus on a year and then start over. Right? You are on a financial journey. The market doesn't have a calendar. Now, it does have seasons, so don't misunderstand that. There are periods of time when it tends to do better than others. But, you are on a financial journey. And one of the things that we show is your drawdown relative to the benchmark of where your portfolio ought to be so that you can see when there's more risk. And the one of the things I have to explain to young planners when they come in is why is it never above the line? Why do you never show what we would call alpha? Right, where you're outperforming based on the risk that you're taking. And it's because that's not what drawdown's about. Drawdown is about the risk. Now, after 32 years of doing this, here's what I know. If the S&P 500 is up 20% and people are up 12, an awful lot of people are plumb tickled. It doesn't mean they ought to be, but they're plumb tickled because they're up 12% and their model says, hey, I'm only going to get 6 or maybe 8. To get 12, Adam, they are thrilled, right? They're just excited. But the reverse is also true, right? When the market's down 15 and we're down 3 or 4, our allocation team has actually done a phenomenal job relative to what's going on in the market. And you still have people, nobody wants to lose 4. Do not ask me if I want to lose 4% going into this year, right? Real or nominal, immaterial, right? Nobody wants to lose money. And so that drawdown becomes important. And one of the things, as you go to look at hiring a money manager, whether it be yourself or whether it be that you're doing it or whether it be somebody else, one of the things you really have to ask is what is your attitude toward risk? And don't just take it for granted. People are going to say, well, we're not risky. Make them prove it, right? Show the process to make sure that is actually taken care of. And that's one of the things that we're able to do inside of the office.
I think few things are as important as that, is to be able to look at remind yourself of what has been done for you, right? And that's just not in charts; it's also in life. What has come through for you time and time again. And so when we think about what is this next shoe going to drop, we just went through one of the worst all-time drawdowns in history, not only in magnitude but in speed. And so we can look back at that period and say, how did you actually do? We survived, right? And in many cases, maybe it was more than they could tolerate. And now that we've recovered, maybe now is the time for adjustment. But that history is so important.
And it's fresh in people's minds. It's we showed a chart in this week's Market Carver, I believe. We certainly talked about it in the allocation meeting. That the number of 10%, which is what is technically what people call a correction, is when a market from the high has a 10% drawdown. Then they call it a correction. 20% is what they call a bear market. Technicians like Andrew would argue over those numbers, but for us lay people, that are not technicians, that's the standard. And what the chart actually showed was there are many more 10% adjustments in the market or drawdowns in the market here recently. They're more they're more clustered than scattered like they were in the past.
Yeah.
And so if I'm getting ready to retire and I'm doing this on my own, I've got my 401k and I'm managing it. Remember, if you have a 401k, you are your own fiduciary unless you have an outside money manager. People will tell you that the mutual fund manager inside is a fiduciary. Legally, that is true, but he's a fiduciary to that mutual fund, not to the individual investors. So his job is to try to make that fund the best. So if you go back to one of our earlier conversations where Adam and I were talking about interest rates and the challenges in fixed income, if you're in a mutual fund that is a bond fund, that manager's job is to take care of those bonds. It's not to reduce your bond exposure, right? It's to manage the bonds that are inside of there, or a small cap or emerging market or whatever that mutual fund is. So if you're your own fiduciary, you really need to understand this. And Adam, how would you tell them if they're doing it on their own to watch out for or manage drawdown?
So, and you hit this early on, and out of 32 years, I think that you'll gather this, that it's not just the math piece that gets you, it's the emotional piece. And most people, when they come in, they intuitively understand that now they're entering retirement, that it's a new phase. They don't have as long for it to make back up. But in terms of what you do about it, you have to revisit your allocation and your exposure. And we'll go back to Japan because I think that highlights such an important example. And if you look at and revisit what happened in that scenario, and if you were a 60-40 investor, we'll go back to that portfolio you referenced of 60% stocks, 40% bonds, and you knew that you were within 5 years of retirement as a 1985. And all of a sudden, the stocks tripled from that point, maybe more. Well, now your 60% is going to be a heck of a lot more. Math on the fly, maybe you're 80, maybe you're 90 at its worst. So your problem and your adjustment at that point in time is if you don't take the opportunity to rebalance the portfolio. And so that is a very delicate term in our office. Often in industry, it's used to be a fixed calendar interval, quarters. The markets don't care, months, quarters. They don't run on that. They run on percentage change. And so that Japanese market went through many periods where a rebalance was in order. And so that's really step one, is what is that underlying exposure? Because now all of a sudden your 60-40 portfolio that you thought you were, it's great that you had the run up, but now all of a sudden when you might have been exposed to a 30 or 40% drawdown, or now you're exposed to a 30 or 40% drawdown as opposed to a 15, 20, 25 that a 60-40 would be a middle of the road. And so really it's that overall allocation that's ultimately important.
Yeah, I think I think the two biggest questions that I hear from the planning side when I'm sitting down with a family and we're doing a family update or somebody new where I've come in to say hi in the room, the first question is how much money can I take, right? And then the second one is what percentage should I have in these various assets? And what I guess I want you to kind of walk through with this is, we have a baseline. You said that of a balanced portfolio, but we use a process that we created internally called the risk barometer, to try to say if the weather's good outside, we can increase equity exposure, right? And if the weather's bad outside, we can decrease equity exposure. It's not, we're not married to any percentage in any of the models that we manage because things change. Right?
Yeah, absolutely.
And if people were doing that inside of the Japanese market, they probably came out, you can have a market 30 years later where you have less of an overall indices, a lower market, and still have very positive returns for individuals. We watched that happen in the market here recently. We may be in the middle of a correction right now as we're doing this. Remember, when we tape it, things change by the time you hear it sometimes. But that doesn't mean everything is correcting.
Yeah, and investors have many options for measuring and controlling risk, and that's ultimately gets to your question of how you manage drawdown. You manage drawdown by managing risk, and ultimately, unless you're a superhero and they're out there, they also have a lot of luck in terms of investors. If you go through a risk control process, like our risk barometer, you leave something on the table on the upside. There are no free lunches. You give up some upside return, but that's exactly the trade-off you need when you're worried about drawdown in the portfolio. And so we'll gladly take that trade-off, particularly in those portfolios that need risk managed and controlled.
So your kids aren't there yet, but when I'm with somebody my age that's got children my age, right? So Kendra's 24 and Kaylee's 28. And I used to always use the example when they were around 18. I said, your 18-year-old and my 18-year-old Adam get in a race to go to Indianapolis. And my daughter drives 100 miles an hour, and she happens to win the race, right? As parents, we do not fly out of the car and high-five her for winning, right? Because we know about potholes. We know about people texting that could have hit her. We know that she could have had a blowout. We know that there's police, right? We know all of the things that could have gone wrong. One of the biggest mistakes I think people make inside of portfolios is not being able to understand the risk after the race has been won. People get their statements at the end of the year, do not understand the risk that they took. I can't look at a portfolio and see risk. As Adam would like to say, it's a mathematical measurement that we're able to go in and see. But portfolios have to be created correctly. And drawdown, my friends, is a huge, huge issue. And Adam hit it. I will tell you, after 32 years, the emotional response to how people behave in market periods of volatility, both up and down, by the way, both up and down, how they behave emotionally is what ends up altering their retirement. And in very few instances is it for the better.
Yeah, and some of the unpleasant, a simpler outcome that you and I have done over time, that maybe the more unpleasant conversation is ratcheting their expectations down, and keeping the percentage they have coming out to a minimum, and not overdoing it in the good times.
That's our job. Hey, you've been listening to Consider This program. Give us a call, 800-928-4001. Get signed up for your Next Steps meeting, yourlifeafterwork.com.